Today, we're digging into the latest jobs cuts report and what it means for your wallet, your career, and the next few months in markets.
Quick headline, companies announced well over 150,000 job cuts in October, and the year-to-date total has pushed past 1 million.
That is a big spike, and regular listeners should care because jobs are the engine for spending, earnings, and the stock market's mood. If the engine coughs, the car can still move, but it burns more fuel and everyone argues about who forgot to change the oil.
And the dashboard lights are flickering. Layoffs accelerated most in warehousing and tech last month, and the reasons listed were cost-cutting, automation, and softer demand.
Before we roll, a quick reminder. The show is for information only, not investing or legal advice. Do your own research and talk to a pro if you need one.
So what actually happened in plain English, and why now?
Employers announced a sharp jump in planned layoffs for October compared with both September and the same month last year. It is the worst October reading in over 2 decades. Year-to-date cuts now exceed last year by a wide margin.
Give me the quick facts, like I am checking my phone between train stops.
1. October layoff announcements surged into the 6 figures. 2. The cumulative cuts this year are the highest since the pandemic year. 3. Tech and warehousing stood out. 4. Companies cited cost-cutting first and automation tied to artificial intelligence second.
That is the news. Here is the metaphor. The labor market was cruising down a highway. Now it just hit a construction zone with a detour sign that reads, "Robots ahead."
And there's a flagger waving a slow sign. Hiring plans have been relatively weak compared with prior years, including seasonal hiring that normally gives a late year boost.
Let's zoom out. How did we get to this point where warehousing and tech are swinging the axe while consumers are still spending on deals and deliveries?
Start with the pandemic hiring boom. Many companies staffed up for e-commerce, logistics, and digital projects. Then demand normalized, input costs rose, and productivity targets got tougher. Now with capital more expensive, leadership is pushing efficiency. That shows up as restructuring, consolidation, and automation.
So that warehouse the size of 16 football fields thought it needed every forklift and every night shift, then realized the robots do not take coffee breaks.
More like management realized volume growth was not matching the payroll. Add in software tools that let a smaller team do more work, and you get cuts.
Tech cuts have become a grim quarterly ritual, but warehousing leading for a month is a twist. Why there?
Overcapacity. During the lockdown era, companies overbuilt storage and last-mile networks. As growth cooled, utilization fell. Automation is improving picking and sorting, and some facilities are consolidating. When a company closes or repurposes a site, headcount drops quickly.
What about reasons companies actually put on paper, not just vibes?
In October, the top stated reason was cost-cutting. Automation, artificial intelligence were cited for a sizable chunk. Broader market and economic conditions and site closures were also common. Earlier this year, reductions tied to federal actions boosted totals as well.
You mean trims in and around government operations that ripple into contractors and nonprofits?
Exactly. When the funding flow changes, downstream employers often react.
Let's dig into the mechanics. Why do executives pick layoffs over pay freezes or slower hiring? Walk me through the incentives.
3 reasons. First, margins. Cutting headcount has an immediate impact on run rate expenses. Second, signaling. Management teams want to show discipline to creditors and shareholders. Third, technology adoption. If the new system can do the same work with fewer people, the spreadsheet wins.
Until revenue slows because service quality drops or projects are delayed, there is a reason many cuts are followed by rehiring in different roles a few quarters later.
Let's pressure test the automation angle. Are we really seeing people replaced, or is this a convenient label?
Both. Some roles are being consolidated thanks to software and machine learning tools. Others are a pretext. When leaders say the quiet part out loud, it is usually that the company hired too fast and now wants to reset costs.
But we should not ignore that the tools are getting better. If a system drafts the first version of a report or routes packages more efficiently, managers rethink staffing. You cannot put that toothpaste back.
True, but there is a lag. Rolling out a new workflow takes quarters. In the meantime, cuts can overshoot. The risk is that companies trim muscle, not fat, and then miss growth when demand recovers.
Investors tend to cheer layoffs and then worry about demand a few weeks later. Classic short-term high five, long-term side eye.
Which is why I am cautious. A spike like this can foreshadow slower hiring, more conservative guidance, and pressure on consumer spending if reemployment takes longer.
Speaking of hiring, seasonal plans are softer than usual so far. That means fewer temporary roles in stores and warehouses, which normally help households cushion holiday budgets.
And that matters for local economies. Fewer seasonal checks mean less discretionary spending in November and December. Small businesses feel that quickly.
Let's pivot to what it means at a personal level. If you're a listener in tech, logistics, retail, and media, what should you do this week?
First, update your resume and portfolio to emphasize quantifiable outcomes and any experience using new tools. Second, build a short list of target employers that are still hiring, including outside your primary industry. Third, keep cash flow flexible. Avoid big discretionary purchases until your job outlook is clear.
I will add, be proactive with your manager. Ask what projects are core to next quarter's goals. You want your name attached to can the can not fail items, not the nice to have experiments.
And if you're job hunting, widen your net. Some sectors still plan to hire, even within companies reducing staff. There are pockets of growth like security, compliance, and revenue enablement.
Shoppers and homeowners, here is your version. Expect more price competition on goods if demand softens, but fewer hands on deck at stores and call centers. Be patient and use apps that show stock levels. On the home front, rate moves could help, but do not plan your budget around a fairy tale pivot.
For commuters and gig workers, watch for fewer overtime hours in logistics and delivery as operations streamline. Build a cushion in case shifts fluctuate.
Small business owners, write this mini checklist. 1. Review staffing models for January and February, not just peak season. 2. Negotiate with suppliers now while they still want to make their quarter. 3. Cross-train to handle absences without panic.
Also, be realistic about demand. If your customers are in industries cutting costs, expect longer sales cycles and more sign-offs. Adjust marketing and cash collection accordingly.
All right, quick breath, quick reset. You are listening to Error 404, Searching for Logic. If you like this kind of straight talk, follow and share it with a friend who loves a good chart as much as a good meme.
Back to catalysts. What could change this narrative over the next few weeks?
A few things. 1. Any shift in interest rate expectations that lowers financing costs can reduce the urgency to cut. 2. Better than expected consumer spending through the holidays. 3. Stronger openings in professional services and healthcare that absorb displaced workers. 4. Revised plans from large employers if productivity programs underperform.
And risks.
If more companies cite automation as they roll into new fiscal years, we could see a second wave of restructuring. If reemployment times lengthen, wage growth cools, and confidence dips, that can feed back into earnings and hiring.
Timelines.
Watch the next 2 monthly updates. Also keep an eye on early January announcements when many firms finalize budgets and teams.
Let's do a little myth busting. Myth 1. Automation only hits low-wage jobs. Reality? It is creeping into white-collar work too, from customer support to financial analysis.
Myth 2. Layoffs always mean a recession. Reality? Not always. But when the pace accelerates and hiring plans weaken at the same time, it raises the odds of a broader slowdown.
Myth 3. If your company is cutting, your career is off track. Reality, many people use this moment to pivot into higher growth roles, often in the same organization.
And myth 4, everyone else is doing fine. Reality, the people who look calm on social media are also updating their resumes at midnight.
Let's each offer one practical play for the market watchers.
Look under the hood of earnings. When a management team touts cost saves, listen for the follow-through on revenue. If top-line growth stalls, the cost story ages quickly.
I watch demand proxies, parcel volumes, travel bookings, and credit card spend. If they hold up while cuts rise, it suggests companies are being opportunistic. If they roll over, that is a different story.
For job seekers, remember that posted roles often represent real needs. Tailor your application to measurable outcomes, not just responsibilities.
And if you are in a role exposed to automation, volunteer to pilot the tools. Being the person who makes the robot useful is safer than being the person the robot replaces.
Last thought on policy. When official data is delayed or disrupted, private reports carry more weight in shaping expectations. But they capture announcements, not actual separations. The translation from headlines to household impact can take weeks.
Good nuance. Announcements are like weather forecasts. You still need to step outside to know if it is raining, but you should probably grab the umbrella when the radar lights up.
And right now, the radar is busy.
Time for 3 quick takeaways. 1. October saw an unusually large jump in announced layoffs, the worst October in over 2 decades. 2. Warehousing and tech were hotspots, with cost-cutting and automation leading the reasons. 3. Hiring plans, including seasonal, look softer, which could dampen holiday spending and slow the labor market's ability to reabsorb workers.
What to watch next? Holiday spending strength, any shift in rate expectations, early quarter announcements in January, and whether reemployment times stretch, which would pressure confidence and incomes.
Thanks for listening. Follow, share, and leave a rating if this helped you sort signal from noise.